Hello and welcome everyone to our webinar today. For those of you who have yet to meet in our live masterclass sessions, my name is Denise Lin and I'll be your host. I'm so glad you could join us because today we'll be diving deep into the two most widely used investing accounts in Canada, the TFSA, Tax-Free Savings Account, and the RRSP, Retirement Savings Plan. You probably know that both these accounts can help shield your investments from taxes, but what you might not know are all the subtle tips and rules we can follow to get the most out of each account. So thankfully, we have Adrian Bar, aka the Canadian in a t-shirt, to help us sort things out today. Adrian helps Canadians understand the basics of investing in his renowned YouTube channel, and he's here today to share his do's and don'ts for investing in a TFSA and RRSP. So hello, Adrian. Great to see you again. Thanks for joining us. How are you today?
Thanks, Denise. I'm so excited. Thank you for having me. I can't wait to get started.
Before we get rolling onto your list, why don't you introduce yourself a bit? Tell us a little bit more about yourself. How did you get started investing? How would you describe yourself as an investor?
Sure, sounds good. Yeah, so I've actually been investing for a long time. I started investing while I was still in university with whatever little money I could save up from co-op jobs, side gigs, OSAP grants, that kind of thing. And actually, when I first started investing, my very first investment was mutual funds with TD. On top of that, I also did some savings accounts and GICs, but I wasn't really getting much interest income from that. As the years went on, I kind of built my comfort with it, and I started expanding on to doing individual stocks and ETFs. And in terms of how I would describe myself as an investor, I'm definitely a long-term and sensible investor, right? I'm always trying to build wealth in the long run. I do not try to get rich quick. It just can't be done. And I really believe in diversification, right? I don't ever want to put all my eggs into one basket, and I try to avoid the really kind of trendy, speculative, risky kind of investments. I want to focus on quality, established companies, things like blue chip stocks that can give me both dividends and long-term capital growth. And as another kind of consequence of that is I never want to try to, outsmart the market or time the market. Instead, I'd rather just invest in the market and match the market returns. And my one kind of go-to mentality is that I believe that time in the market will always beat timing the market, right? So always try to invest in the long term. That's my strategy.
Ooh, I like that. Now, this is quite interesting because your background is in mathematics and software engineering, right? So here you are running a YouTube channel about investing. How did that happen?
Well, again, so I studied mathematics and I'm an engineer by trade. So for me, I've always been kind of obsessed with efficiency and optimization in all aspects of my life, right? I want to make sure that I'm working, my time, my energy, everything is spent as effectively as possible, right? And my money is a big part of that. I know how hard I work for my money, so I want to make sure that my money is working just as hard for me, right? And all throughout my entire career, even when I was in university, I've always worked multiple jobs. I always had different side gigs. I worked as a freelancer. I had different businesses, and so with all those kind of different ventures, I want to make sure that I'm not wasting money on fees or penalties or taxes. So I basically learned the Canadian tax code inside out so that I can minimize those tax bills and save more money for these business ventures and watch them grow even faster. And a really cool thing was that in my last full-time job, and I was working as an AI software engineer, I was responsible for hiring dozens of co-op students, and I led multiple projects. And every semester when we had a new batch of co-ops, I would host these lunch and learns for my co-ops where I would teach them important life skills like resume building, interview skills. But one of the things that the co-ops really liked is when I taught them personal finance fundamentals, things like Canadian taxes, credit cards, the basics of investing. And these students, they ate that up because no one had ever taught them this. And I noticed that after each semester went by and new students came in, I was kind of making the same speech again and again. So I decided, instead of just kind of making these same lunch and learns every couple months, why don't I immortalize these lessons in videos? And then eventually I said, if my co-ops like them, maybe I should put them online on YouTube. And that's what I did. I started it purely as a hobby. I didn't really think anyone was going to be watching, but slowly my YouTube channel kind of gained traction. And it kind of grew and eventually became a business. And now it's my full-time career. So it's definitely been an interesting journey, but it's always been a passion project for me.
Oh, well, congrats on building such a strong following on your channel.
Thank you.
I've tried and I've definitely failed. So I can say for a fact that it does take a lot of dedication, time, and effort. So let's get talking about these TFSA and RSP accounts. So as we know, many Canadians are familiar with these names. That's what I started using when I was starting to invest. Those two accounts were introduced to myself, but a lot of us may not understand how they actually differ. So what are some of the key differences between like a TFSA and RRSP?
Right. So there's definitely a lot of similarities because they are the two main tax sheltered investing accounts for Canadians. But the main difference is I'll start with the TFSA. The TFSA is very simple and flexible. Basically, even when you withdraw that money, and if you want to withdraw that money and spend it on whatever, you don't pay taxes on that withdrawal, right? However, with the TFSA, since it's more simple, you also don't get some of the benefits of the RSP. So for example, with the TFSA, it won't reduce your tax bill. The TFSA will just avoid taxes on future investment income that you'll earn. And another difference is that with the TFSA, everybody gains the same amount of contribution room every year. So your TFSA room only depends on your age. With the RSP, it's definitely more complicated and there's a lot more rules and a lot more things to consider with an RSP. Basically, with an RSP, when you contribute money and you put money in, you can reduce your tax bill now, ideally during your high income years, and defer those taxes for years or even decades until retirement. Ideally, when you're in retirement, you'll be in a much lower tax bracket. So you'll pay much lower taxes when you finally withdraw that money out of an RSP. Also, with the RSP, it's definitely less flexible. You can always choose to withdraw money from an RSP even before retirement, but you will be taxed on that withdrawal and you don't regain that contribution room like you do with the TFSA. If you withdraw money from an RSP, that room is gone forever. And another difference is that with the RSP, your contribution room, the room you have available, it depends on your income. Basically, the simple calculation is that 18% of your earned income, that means salary, business income, rental income, but not investment income, 18% of that income gets added to your RSP room. Although there is an annual cap, usually it's around $27,000. So for most people, especially if you're older, you'll likely have more RRSP room available than TFSA room.
Okay. Wow, that's a lot. But it's great because like it really does help us separate between the two accounts. So thanks for clarifying that up. Now, for anyone that's interested in learning a bit more about these subjects, there are plenty of videos, masterclass sessions, and webinars on these subjects as well. So don't be worried. I am recommending that you can start off with some of our on-demand webinars. There's one that we can actually look into called the TFSA RRSP, which is the right account for you that we can just take a look at a bit more and expand on these two accounts. Adrian, let's get back to this though.
Yeah.
Now, the first due on your list does actually apply to both the TFSA and the RSP accounts. So you say that investors should use them for investing rather than savings. Why is that?
Well, the main benefit of both the TFSA and the RSP is that you get that tax sheltered growth while your investments stay within those the TFSA and RSP, right? And it's a little bit frustrating because it's kind of misnamed. The word savings is actually in both TFSA and RRSP, right? So it's definitely confusing and a little, frankly, misleading. But the reason why is that savings interest, especially right now, is absolutely pitiful, right? So that income you're earning from interest doesn't even beat inflation. So you're not even breaking even. You're actually kind of losing money with a savings account. And so yeah, you're not even, I mean, you're barely earning any interest income anyway with the savings account. So whatever little amount of income you'd be earning, you'd barely pay any taxes on that, right? So putting that in a tax sheltered account and saving on those tiny taxes really doesn't add much benefit. It's frankly, that precious limited room is frankly being wasted on savings. Instead, you should use a TFSA and RRSP as an investing account. Let's say you do, even if you do very conservative, boring, reasonable investments, you will save significant taxes if you hold those investments in a TFSA and an RRSP.
Yeah, for sure. That's a very popular misconception that these accounts need to be just for savings because, like you mentioned, it's just built in the name. So for beginner investors, that's what we automatically assume or start thinking. So thanks for letting us know or clarifying or stressing that point. Going back to our list here, for your first don't, it's also applicable for both these accounts. So you stress that investors shouldn't hold speculative investments in TFSA or RSP accounts. So before we get into this, what is considered a speculative investment, and can you explain why we should avoid holding these types of investments in these accounts?
Right. So a speculative investment is basically a risky investment where you know that it's not a very safe bet. It's kind of a risky bet, but you hope that the reward will beat the risk, right? So it's basically if you're investing in a penny stock or a recent stock that was just listed on the stock exchange, so an IPO, or if it's a new type of crypto, or anything like that, where you don't know for sure in your gut, will this company even have a future? Will this company even be around 10 or 20 years from now, right? You don't know, but if it is around, it has the possibility of maybe doubling or tripling in value, right? That's what a speculative investment is. And I really kind of stress the fact that it's risky because the vast majority of these speculative investments crash and burn, right? They don't double, they don't go to the moon. They generally speaking go to zero, right? And when they go to zero, you lose all your money. It doesn't matter whether you had $1,000 or $10,000 invested. Once it's zero, you have nothing, right? If you sell a stock at a loss in a TFSA or an RRSP, you permanently lose that precious contribution room. And with both these accounts, that contribution room is so limited. And when you sell stocks at a loss, you don't regain that contribution room. It's not considered a withdrawal like it would if you took money out of a TFSA account. If you sell your stocks in a TFSA at a loss, it's not a withdrawal. It's just money that you lost. You don't get the contribution room back. So you're always going to be a few steps behind someone else who's the same age as you who didn't make those speculative investments in their TFSA or RRSP. Again, I really want to stress this point. The TFSA and RRSP is really designed for long-term investing.
Okay, that's a good point to think about next time we all consider or want to start looking at speculative investments. Now, we've gone over some of the tips for both these accounts, so let's dive a little bit deeper in the TFSAs. For you, we have rule number 3. So do max out your contributions as early as possible.
Right.
What's the benefit in that?
Well, so again, with the TFSA, the main benefit is that you get the benefit of tax-sheltered growth, right? So the earlier you contribute and invest in your TFSA, the more time your investments have to grow and compound totally tax-free. If you have the room available, invest that money right away in your TFSA. The way I look at it is, why pay taxes on your investment income when you have tax sheltered room just waiting for you in the TFSA? Towards the end of the year, in December, I would try to save up whatever cash you have so that as soon as January 1st hits, the new year, you gain that extra $6,000 of TFSA contribution room, and you could put that cash in and start investing tax-free, right? Or if you've already invested some stocks in your non-registered account, on January 1st, you can actually transfer those stocks from your non-registered account into your TFSA.
So for those of us who are thinking about what should we really focus on, is it the TFSA because of all those tax shelter benefits you mentioned, or is it the RRSP, or am I supposed to be contributing to both at the same time? What's your approach with that?
Again, this is a question I get all the time, and I have to give you an annoying answer. It really depends, right? It depends so much on your age, your income, your retirement plans, your risk tolerance, your time horizons, what you want to do with that money. Again, this is a huge topic on its own, and I wish I could give you an answer, but it's not. There's no one size fits all, right? It really does depend on everyone's circumstances. Ideally, the ideal situation is you want to max out both if you have the money, obviously, right? But I'll break it down real quick. If you have a high income, meaning you're in a high tax bracket, then the RRSP will most likely give you an even greater benefit than the TFSA because you can reduce your tax bill while you're in that high income, high tax bracket. That gives you more money to invest with now, and that gives you a larger opportunity benefit because now you have a larger sum of money this year to invest with and grow year after year, right? But if you are in a lower tax bracket and if you don't see that your income will increase significantly in the next 5 to 10 years, or if you don't think that your income, or if you think that your current income will be roughly the same as your retirement income, then the RRSP really doesn't give you as much of a benefit. In that case, I would definitely focus on the T-of-A. But again, it does depend on a multitude of factors.
Okay. Okay, got it. All right. So maxing out TFSA is the priority if possible, and then RSPs can help out if we have that a high income level. So everyone's individual contribution limits for the TFSA is actually quite different, which we can find on our NOA. So that's notice of assessment, or even by just contacting CRA or online CRA account. This is important to be aware of because we don't want to exceed our own personal contribution limit. That's what we want to just make sure and be aware of. That brings us to our next don't. So you mentioned don't recontribute money you withdraw in the same calendar year.
Right. So with the TFSA, again, it is quite flexible. You always can withdraw money, although ideally you should. You want to kind of keep that money invested for the long term. But with the TFSA, there is a little bit of flexibility. So whatever amount you withdraw from your TFSA, you regain that withdrawal amount in the new year on January 1st, right? So let's say you've already maxed out your TFSA and then you withdraw $5,000. You want to, I don't know, buy a new furnace for your place, right?
Buy a boat.
Whatever, buy a boat, right? Don't do that. Invest that money instead. But anyway, you withdraw $5,000. You can do whatever you want with it, right? Since your TFSA was already maxed out, you can't put that $5,000 back into your TFSA until January 1st of the new year. If you do decide to put that $5,000 back in, at that point, you have exceeded your limit. And the CRA will charge you harsh penalties. They'll charge you a penalty of 1% every single month on that excess amount. That's 12% a year. I definitely stress everyone, make a habit of recording all of your transactions. Record every single contribution and every single withdrawal you make from your TFSA and RRSP. It's always your responsibility to know exactly what your available room is at any given moment. Don't rely on your bank. Don't rely on the CRA. They're not going to give you a live, up-to-date number. It's your responsibility to keep track of that.
Yeah, that's very true. When I was with TD Asset Management, or just they would ask me a lot about the contribution limits, and I wish I knew, but we actually don't have access to that. So definitely check out your NOA, CRA website, or even give them a call. And like Adrian mentioned, keep a little checklist just so that we're more aware of our own investment accounts. So as self-directed investors, we have all struggled with this at one point, right? That feeling of overwhelming, lost, or being confused with all of these options available for us. Adrian, we both know that there are many different investments, and each of them can be taxed a little bit differently depending on where they're from, where they're held. So your next rule is to hold Canadian dividend stocks in a TFSA, should you choose to invest into them. Why is that?
This is a very kind of deep topic on its own. I could talk about this for 2 hours basically. But basically, again, with the TFSA, every single investment you put in TFSA will benefit from the tax sheltered nature of the TFSA. However, Canadian dividends actually get the most benefit of this tax sheltered nature, right? Dividends in a non-registered account are taxed definitely higher than capital gains. Dividends are still taxed lower than regular employment income, but they, especially for higher tax brackets, they're definitely taxed somewhere in between capital gains and employment income. Another thing with dividend income is that you can't control when you pay taxes. You can't delay them for years. If you receive a dividend this year, you will pay taxes this year. There's no avoiding it. There's no way to delay it. Every single year when you receive dividends, you have to pay taxes on those dividends. Another thing is that there's no way to kind of offset that or defer it, right? And the way I look at it is that taxes you pay on dividends is kind of like a constant brake that slows down your dividend investment growth. So in a TFSA, dividends gain even a much greater tax benefit than capital gains do.
So we actually do cover a lot of these tax details in our video courses, and we do have readily available on-demand webinars within our library that focuses more on these tax planning strategies that Adrian's been enlightening us about. So do make sure you check that out if you want to learn a bit more. I've noticed that U.S. dividend stocks are taxed a little bit differently than Canadian dividend stocks, right? So this brings us to your number 6. You stress that we shouldn't hold them in our TFSA account, but we just stress that TFSA accounts are tax-free. So why should investors avoid doing that?
So this is another kind of really common question I get, and unfortunately, a lot of Canadians aren't aware of this information, right? The TFSA is tax-free. But unfortunately, it's only 100% tax-free for Canadian investments. U.S. dividends, on the other hand, if you hold U.S. dividends in your TFSA, you won't pay any Canadian taxes on those U.S. dividends, but you will be charged a 15% withholding tax to the IRS, to the U.S. government. One thing I want to point out that is that this 15% withholding tax on U.S. dividends, this tax is taken out immediately when you receive the dividend. In a cash account, you can actually claim a foreign tax credit to kind of offset that U.S. Dividend tax, because basically the Canadian government will avoid you being double taxed, right? It wouldn't be fair to pay the U.S. government and the Canadian government taxes on the same income, right? But in a TFSA, you don't get that benefit, right? There's no way to avoid that 15% withholding tax. And just I want to kind of stress this point, right? So with the withholding tax, it's charged immediately. And the way it works basically is that if you were to expect to receive $100 in U.S. dividends in a TFSA, you'd only receive $85. That $15 is a tax that's taken off right away. You never see that money. So you don't have to worry about paying it or filing it. It's taken automatically immediately as soon as the dividend is paid out. The only way to fully avoid this 15% withholding tax is to hold your U.S. dividend stocks and ETFs in an RRSP instead of a TFSA. And that's because there's the U.S.-Canadian tax treaty, which gives special treatment to registered retirement investment accounts, things like the RRSP, things like the RIF, things like the LIRA. However, the U.S. government does not recognize the TFSA as a retirement account. So the RRSP, you can waive those 15% withholding taxes. With the TFSA, you can't.
Now, I did want to speak more about the RRSPs because their tax treatment can be a little bit confusing. We can use contributions to our RRSP to lower our taxable income, but Adrian, you say this is something you would only do in higher income years.
The way the RRSP works is that whatever money you contribute to the RRSP, you can deduct against your taxable income. So let's say you made a salary of $100,000 and then you contribute $10,000 to your RRSP. Now you can reduce your taxable income. So you're not taxed on the full $100,000 you made, you're only taxed on the $90,000, right? And a benefit here is that since you've likely already paid your taxes from every single paycheck that you get, the government, you've now overpaid your taxes. So now the government owes you money, so you'll receive a tax refund from the government. And claiming this RRSP tax deduction definitely makes more sense when you're in a higher income and in a higher tax bracket. If you have a lower income, you're in a much lower tax bracket, so you already pay far less taxes. So claiming that tax deduction gives you a far less benefit. But one very important thing that a lot of Canadians don't know is that even though you put money into your RRSP, you do not have to claim that tax deduction right away. You can carry forward that tax deduction for years and years until your income grows. And that's exactly what I did. Okay. I first started contributing to my RRSP when I was in university, right? When I was in university, I had a little bit of income. I worked a few side jobs. I had co-op jobs, but my income was very, very, very low, right? In fact, I was far below the basic personal tax amount of $13,000 that everyone gets, which means that since my income was below that amount, I wouldn't pay a single dollar in taxes anyway. So even though I contributed money to my RRSP, claiming that tax deduction would have been literally useless. I wouldn't have paid any taxes anyway. So claiming that tax deduction would have been a total waste. Instead, what I did was I contributed to my RRSP to take advantage of that tax sheltered growth for years and years, and I carried forward that deduction for about 3 or 4 years until I started working and I was in a higher tax bracket, and then when I claimed it, I was able to get significant tax savings.
So TD does actually also have a tax center, so please feel free to leverage that as well. And of course, follow Adrian later on. Well, thank you so much for sharing such a thorough list of suggestions with us all here. And we're not quite done yet. We are about to transition into our Q&A shortly. But before we do so, you've been so educational, informational. Please tell us where we can actually find you after this.
Well, thank you, Denise. Yeah, so absolutely. Please look me up on YouTube. My YouTube channel is called Canadian in a T-shirt. And if you want to reach me, please, the best way to reach me is YouTube comments. I take a lot of pride in the fact that I spend hours every single day.
You'll read and you'll reply us?
I try to respond to every single comment I can. Obviously, as I grow larger and larger, it gets harder and harder to do that. But I really do kind of value that engagement. I never really want to lose that. So I really try my best to answer as many comments as I can every single day. But if you do have a more private or sensitive question that you don't really want to put out there publicly, then the best way to reach me would be either Instagram or Facebook. Send me a message. My handles there are Canadian T-shirt.
Okay, perfect. Well, there you have it, everyone. This does conclude our first portion with Adrian. We're going to transition into our Q&A now. So if you've yet to submit your questions, it's not too late. We're both really excited to see what you're all thinking about. Don't forget to look into those additional resources that we do have listed here for you. And of course, all of Adrian's handles and where to find him is there as well. If you have enjoyed this webinar, there are many more upcoming ones to really look forward to, and registration is open. So please do check that out. All right, Adrian, are you ready to get started with some of the questions from our audience?
I can't wait. Let's do it.